Tyler Technologies, a stock we've mentioned in passing a few times, I think, on the show, but never really looked at in much detail. The stock, as far as I can see, has generally held up okay this week. They haven't had an earnings report, but they're the kind of software as a service company that has not been going terribly well. As I look at it on this week, they are down 2.7%, which is, I mean, it's not the kind of crashy thing you've been seeing recently from other companies. And this doesn't look to me like a crashy software stock either. Market cap is 20 billion. PE ratio is about 64.5, which is unusually low for this company. When I looked earlier, I expected to see it beginning with a 7 because it usually does. And I expected it to have 2 digits because it usually does. In other words, it's a pretty good software company and the market generally knows it and has been, as far as I can tell, overpaying for it for as long as I can remember looking at it. So nice niche things, but what do? They do local government software for all kinds of exciting things, but state government and local government in the US, not really federal stuff in general. They do court software, they do incident report software, they do billing software, they do permitting software, they do all the exciting stuff that local governments do, and roughly are getting them to try and move themselves from pens and paper to some sort of online digital things, rather than having to drive your damn documents into your local authority office. You can fill them in online. It's about as straightforward as that. It tells you a bit about how slow moving these things are. And I think there is when I've thought about this before, it was presented initially, I think, on the Motley Fools podcast as a kind of obvious strength for Tyler that they were competing with pens and paper rather than an incumbent software provider. And I get that, and I hear why. I also note in my own head that anyone who's still using pens and paper in this day and age is probably pretty reluctant to do anything else. They are slow moving to change in general. It's not like someone hasn't said before, guys, we've got this thing called a computer. They've seen it, decided against it, and thought, actually, the system we have works fine. And that actually is weirdly hard to disrupt in certain industries. You may well have a thing that works better, but local government is just slow. Insurance is just slow. They have systems and processes that are fine. These things are kind of, strangely hard to get people to move on from, even if they ought to. But here's what I like about this company and why I don't view this as an obvious AI threat casualty for people writing software using similar AI code type things. This has a nice benefit to it, which is that you don't just get to pitch up and start selling things to your local government. This is pretty much a regulated industry of a sort. You need various approvals, whether that's CJIS for law enforcement or SOC 2 for system controls or whatever else. These things also vary quite a lot by state to state, by authority to authority, and in some cases from case to case in various different ways. So what you need on top of that is stuff like proof of integration. It's not quite as straightforward as saying, look, we've got an alternative here, so you can use Tyler's and keep paying their increasing prices, or you can just come and use ours for either less or free or something like that. There is a certain kind of proof of concept that you have to have in these industries, and when you have that kind of thing, it's a lot harder to try and get across someone else than moving across. In other words, it's not so much there are switching costs, because there are switching costs sort of everywhere if it's a pain to move your systems from one thing to another. That's true in general, but I think a thing that I'm thinking at the moment with AI is that switching costs, yes, but for the right price, people will switch. If they think they stand to save enough and get a good enough deal, they will uproot themselves from Salesforce or whatever else it may be, and take that cost if they think there's enough of a saving to be had. And that limits your pricing power if you think that someone's going to sit underneath you in terms of cost and then gradually try and attract your customers away. So what are we thinking in this case with Tyler Technologies? The main thing is it's hard to get around these kind of requirements. But from a buying perspective, I'm also not really there either, to be honest on this. Steve, revenue growth has been about 15% over the last 10 years or so. And I would stick an asterisk on that as well, because they've been acquisitive along the way, and that kind of means your organic growth rate is somewhat slower than that, I think, too. So 15% pushed along by some acquisitions. I'm not anti-acquisition, but I am wary about projecting that out just in a straight line going forward. Trading at a free cash flow multiple of around 30, but like a lot of these software companies, they don't have crazy stock-based comp. It's about 25% of their free cash flow, which is high and higher than I like to see. But you can sort of take that to about 38 times or so, which is, again, higher than you might like to see, but it's not the biggest and most ridiculous number you've ever seen. The balance sheet, which I should have begun with, because obviously this is a growth stock at these kinds of multiples. They have about $1 billion in cash on their balance sheet, net of everything. And I often think, I'm increasingly coming to think, and so you ought to have net cash on your balance sheet if you're going to be paying your workers in stock and printing stock for. I don't know that they've used it for acquisitions necessarily, but you ought to be cash heavy if you're busy using dilution here. You're not using cash for that, so you ought to have it available. All in all, I like this. It is another example of the kind of thing that I think I'm looking for as a potential. If this crashes, I will get interested in it. Because I think it is harder to disrupt than a lot of the software companies that I'm seeing getting hit in the AI nuggets. But at the moment, it's a watch list candidate rather than a buy list candidate, I think, in my case, Steve. We've talked about this a little bit before. We've mentioned it occasionally, and I've mentioned it as a sort of nice kind of niche. I don't see the hyperscalers or whoever poking around in this space because partly the barrier of entry is too high, and partly the market's not really big enough to justify this kind of thing. And there's something nice about being a biggish fish in a small pond. That means you're protected from above and you're protected from below. You're a big enough fish to fend off other smaller upstarts. I don't see them getting disintermediated either because of regulatory rules. And you're in a small enough pond that it's not worth other fishes coming in. What do you think about this one?
Yeah, so I would describe it as like a disparate collection of software companies kind of glued together under a conglomerate, maybe a little bit like a constellation software, Steve, which is probably something that people have come across before. It's always traded at a very, very rich premium, and that seems to be continuing. Despite being down 20% on the year, it still looks like its PE ratio is in the 60s, according to Google, but I'm not entirely sure if that's correct or not. I had a read of the latest report, and essentially they're a company that still doing really well, but are in transition at the moment. They're trying to move a lot of their customer base into the cloud, and also onto more software as a service style agreements. The SaaS revenue in the company grew about 20%, and about 96% of new contracts signed in the last quarter were moving on-premise to cloud. They call it flips. So flips from on-premise to cloud or from something to SaaS was 96% of the new software contract value. And also you can see that maintenance revenue is down about 4%, which shows you that they are, successfully moving people away from these on-premise solutions into the cloud. There's some interesting bits and pieces, Steve, because it is quite disparate. The transaction revenue grew about 11.5%. That looks like that was just over $200 million. Higher transaction values for both new and existing clients, alongside increased adoption of their payment processing services. This is a high margin revenue stream for them as well. They talked a lot about AI, Steve, because why not? Lynn Moore, the CEO, said that the next cycle of transformation will be driven by AI, and Tyler is positioning itself to lead this shift. They're going to build on foundational principles, strong governance, and strategic partnerships, which they said that they're in talks with Microsoft, OpenAI, AWS, and Anthropic. And as part of this, they're going to significantly increase their R&D investment in the full year, signaling this commitment to the AI cause and continue the innovation to maintain its competitive edge, which is something that they'll have to do, Steve, because what they don't want is somebody coming and sweeping up some of the business using AI. They have to have a way of countering this. As you say, Steve, they're in this kind of weird area where it's probably not worth somebody's time to create some software to come along and sweep it up, but it might be worth somebody targeting the business as a whole and creating lots of little disparate bits of software. So it's important that Tyler stays on top of that. They said that they've not seen a fundamental change in public sector demand. They think budgets within America remain resilient, and funds are increasingly being directed towards technology for efficiency and technology for productivity in the US, and Tyler's quite well positioned to sweep a lot of that up, and that was reflected in their guidance. Steve, they said about 2.35 to 2.335 to 2.36 billion, which would indicate about 10% growth for them as well. So I thought that was pretty decent, really. I thought this was a pretty decent report, really. It's much of a muchness, Steve. It's what we've come to kind of expect from Tyler Technologies, and yeah, I think it's a very impressive business. I can see why you'd want it on your watch list. I think the problem I've probably got with this, Steve, is that in order to figure out what I really thought this thing was worth, I think you'd have to do a sum of the parts, and I think that's a hell of a lot of legwork to get that somewhere near where you'd want it to be. Management still think this is pretty cheap, Steve. They bought about 300,000 shares in the last quarter, so they think there's confidence that this business, improves from here. I'm not entirely sure I'd be buying back shares at this kind of area. I suppose that they're probably trying to offset some of the dilution there by doing that. But yeah, I thought this was a fair report, Steve. The market is not very happy with it at the moment, though, and I guess we'll have to see how that goes. What sort of price are you looking for, Steve? Do you have an idea yet?
No, it's a good question. It might be about 20% lower than it currently is. To be honest with you, that would take you down to sort of forward in around the 25 region, which is, I don't know, that could work. I'm looking at their kind of share count, actually, in terms of stock buybacks and stock-based comp, and it's worked its way higher, sort of, over the last kind of 10 years or so, at a rate that's not unreasonable but is fairly consistent, and I think that's also one to kind of keep an eye on a little bit. I like it. I think it's hard to see how it ever gets to the top of my list unless something dramatic happens. I wonder whether that there's a chance that could happen with the market misreading its disruptability here, because there's a lot of talk at the moment, I think, from people who are not really paying attention closely enough to what's going on. And they've suddenly started thinking that something has made AI valuations matter in a way that they haven't before. And I don't think that's quite true. It's nearly never valuation that causes stuff to crash. It's a valuation partly that tells you what crashes. So if something suddenly, for instance, interest rates rising was the thing that last caused things to go the wrong way in a big way. And yeah, that's really bad news if you're on a big multiple or something, because your growth just becomes uncertain and that's what's built into the stock. But stuff traded on big multiples at the end of last week. There's no reason that says it can't trade on big multiples again at the end of this week. There's no law that says what goes up in terms of PE ratios has to come down again. Certainly not in any good kind of orderly in time fashion. But yeah, maybe. If this thing goes in for a 20% dive or so in the style of some of the things we've seen this week, put me down as interested. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.